Hello students, welcome to my YouTube channel Sun Academy. I am Naresh Sir. Today in this lecture we are going to start a new chapter in financial accounts for F.Y.B and that is alteration of share capital means redemption of preference share capital. Now what is redemption of preference share capital? As we know, redeemable preference shares are always redeemed after its due period, and to redeem that share capital, company must have reserves which are available for dividend, or out of fresh issue. Company can only redeem its preference share capital on these two conditions. First, company must have reserves available for dividend, or company will have to issue new shares of any time, whether they are equity shares or they are preference shares. Now, how company will write journal when preference shares are redeemed at par? So, preference share capital account will be debited to preference share holders account. Preference share capital account will be debited and preference share holder account will be credited. When preference shares are redeemed at premium. So, entry for that will be preference share capital account debit, premium on redemption of preference share account debit to preference share holders account. Now when payment is made, whether in this condition or on this condition, preference shares holders account will be debited to bank account. Now payment has been made. Now when fresh issue is made, that suppose is of equity shares, so bank account debit to equity share capital account. If that is of preference share, then entry will be bank account debit to preference share capital account. Now there is a hidden condition. If preference shares are partly paid up, then company must need to call in arrears. So when call is made of partly paid up preference share. So bank account debit to preference share call account and preference share call account debit to preference share capital account. If preference share are partly paid up, then first call is made, then after company can only redeem the preference share capital, otherwise company cannot redeem the preference share capital. Condition number 2, if preference share capital is redeemed of 5 lakh, a new issue is being made of 3 lakh, then for 2 lakh company needs to create capital redemption reserve. Means how much capital is redeemed, that much capital must come in the company in form of new issue. If new issue is of less amount, then company should create capital redemption reserve of that difference amount, and that is created out of reserve. So profit and loss account debit or general reserve account debit to capital redemption reserve account. This reserve is created out of the reserve which is available for dividend. Then after, if company is redeeming preference share at premium, then this premium on redemption of preference share capital account must be written up out of the available security premium or profit and loss account. For that entry will be written profit and loss account debit or security premium account debit to premium on redemption of preference share. That means this account must always be closed. Now repeat we again. When preference share capital is redeemed, it must be redeemed out of the reserve which are available for dividend or out of the issue of new equity share capital or issue of new preference shares. Now entry for that will be when preference shares are redeemed at par, preference share capital account debit to preference share holders account. If preference shares are redeemed at premium, then entry would be preference share capital account debit, premium on redemption of preference share account debit to preference share holder account, and when payment is made, whether that is at par or at premium, preference share holder account will be debited and bank account will be credited. Then entry about the new issue of equity share, bank account debit to equity share capital account. New issue is of preference share, then entry will be bank account debit to preference share capital account. But before this, there was condition, preference share must always be fully paid up to redeem. If preference shares are partly paid up, then first call is made, then after preference shares can be redeemed. Without calling the call-in areas, company cannot redeem preference share. So first call is made, bank account debit to preference share call account debit to preference share capital account. Then after company can redeem preference share. Second point is, if capital is redeemed of 5 lakh, then new issue should be created of 5 lakh. If it is not possible, new issue is being created of 3 lakh, then 2 lakh must be created capital redemption reserve. or company has available balance to create capital redemption reserve, then company should create capital redemption reserve and company don't need to issue new shares. If company is willing to issue new shares or company has to adjust bank balance, for that company has to issue new shares, then for the remaining balance company will create capital redemption reserve, and that is of reserves available for dividend. Those reserves will be debited and capital redemption reserve account will be created. Third point is premium on redemption of preferential account should be closed, and that out of security premium, or when new shares are issued at premium, then those premium will be used. If there isn't any balance of security premium, then profit and loss account will be used to close the premium on redemption of preferential account, and that will be profit and loss account debit or security premium account debit to premium on redemption of preferential capital. Now these are journals which are needed to write when question is asked. Now if you want to learn sums of this chapter, do follow. If you haven't still subscribed, you should subscribe because that is very beneficial for you. You will be able to learn different kind of sums, and if you haven't still shared the link of my videos, you should share the link.